So for this year, I mean, I'm bullish on Bitcoin, gold, energy. That's kind of the big areas of focus for me at this time. A lot Bitcoin's already had a lot of powerful price action, obviously, earlier this year. So I think now it's consolidating a little bit. But over this year and next year, I'm bullish on all those assets that I mentioned. And of course, it depends on what their capital mandate is. So, energy is cheap and profitable and has good balance sheets generally. Gold and Bitcoin are kind of alternatives to treasury bonds or alternatives to tech stocks, for example. They can fit in a portfolio in that context. And so those are kind of the assets that I find attractive at the current time. So I think that large cap growth equities have valuation concerns. So, for example, large profitable tech companies, even companies like Costco, for example, they're very highly priced relative to their fundamentals, relative to their growth. Basically, it's not a problem necessarily with the companies themselves. I mean, Costco is doing amazing. It's just that investors are really crowded and really kind of piling into them. So, I do have valuation concerns for those. I don't really have valuation concerns for energy for certain ends of the value spectrum for some of these smaller companies, nor do I have valuation concerns for gold and Bitcoin. Instead, it's just a matter of that sometimes they can get euphorically overbought in the intermediate sense. So that's something I look out for. But other than that, I think that those areas are still not very crowded in terms of overall investor portfolio positioning. So I think you have to be sector specific. I think that's been the challenge. So over the past, call it 18 months, we've had a PMI, a Purchasing Managers Index below 50 for like a year and a half. And so that's already been recession-like conditions for certain industries. And of course, commercial real estate's been in a depression-like context. Whereas some of the more service-oriented businesses out there, tech, there's other areas that have been in recovery mode. Um, and so I think that some of that could rotate in the sense that some of the things that have been doing really, really well could increasingly show some weakness ahead. Whereas some of the things that have already gone through that down cycle, and if anything, I think some of them are recovering. I expect probably higher PMIs by the end of this year than we started the year at. And I think some of those more cyclical things could follow that. So I think that question of slowdown versus not slowdown is very sector specific. I think instead it's more of a rotation, a reacceleration, some of those things, even as some of those bigger tech things, do slow down. So I do, but I think that even some of the action we've seen is indicative of not super bullish sentiment. People don't pile into Costco at 50 times earnings necessarily purely out of bullishness. Some of that is because it's actually a form of defensiveness. It's saying, I don't really want to own bonds per se. I want to buy a really blue chip company and I'll crowd into that rather than owning any of the things that are more cyclical, the energy names, the banks. That's the capital flight out of there, I think, has been indicative of risk off behavior. And so I don't view that the current period we've been in as super risk on. And instead, it's more indicative of fiscal dominance, indicative of how many other areas are perceived as non-investable. And I think what we could see is a broadening out of what is perceived as investable, right? So some of the risk sentiment could actually increase for some of the things that have been considered too risky. Whereas some of those things that people crowded into, I think people could get quite concerned with the level of valuation there relative to the growth numbers that are coming in. If you've seen, for example, Apple and Tesla just not putting up amazing numbers. And the problem is that investors had overpaid for relatively spectacular results that they're not getting in the fundamental data. So I generally like industrials. I like energy. Energy, I think, is the more attractive risk reward. And I think with financials, as long as you kind of avoid the commercial real estate concentration, I think most of that is decent at the current time. I think those are. I think even for example, the midstream energy sector, for example, that's been showing signs of breaking out. It's kind of new post-pandemic highs, let's call it. And they pay you very high yields while you own them as well. And so I think that there are a bunch of investable areas, and that the market has largely not wanted to touch those, and that those are, even at the current time, presenting opportunity. Now, when you get kind of overall risk off sentiment, bad days, you can get capital pulling out of those as well. But basically, by being cheap and having good fundamentals, they somewhat limit the downside, and then they pay to own them. So even if the upside takes longer to come to fruition, it's still a positive carry asset for many of these while you own it. Well, so I think if someone is a professional commercial real estate investor, I think that there are going to be opportunities, right? Obviously going to be bargain hunting, like super cheap opportunities. But in general, I think we're seeing just an ongoing slow motion train wreck in commercial real estate. I think there are more losses coming. I think that lenders that are heavily exposed to commercial real estate are likely to continue having problem. I would say a lot of that's already priced in. A lot of that, a lot of those things are already super cheap. Capital, it's a very well known theme at this point that commercial real estate's in trouble. And I think that a theme I've been making is that so many people keep saying that commercial real estate is going to drive the next recession. Whereas what I've been pointing out is even the bearish assumptions are looking at, say, like 1.5 trillion in equity wiped out of commercial real estate. Whereas if you look at fiscal deficits, they're over 1.5 trillion per year. And overall household net worth is something like what, like 140 trillion and rising at all-time highs, right? So there are these pockets that can do really badly, and that, if you're exposed to a bank that has a disproportionate amount of lending to commercial real estate, for example, there still could be more shoes to drop there. But that if you're in areas that are not really in that area, if you're in energy, if you're in other types of finance, if you're in other assets in general, even certain emerging markets, those can I think continue to reaccelerate out of their kind of pandemic lows, while these other things continue to suffer because we're in this environment of kind of structural fiscal dominance. It's very hard to have a recession when you're pre-stimulating to the tune of 1.5 or $2 trillion a year in fiscal deficits. And that doesn't mean that's not necessarily a good thing. But it's a different reality on the ground. And a lot of it is kind of like an emerging market where you have to separate nominal expectations from real expectations because you have that underlying kind of fiscal unsustainable backdrop. And that just changes what investments make sense in a nominal sense.